You think putting money aside is enough to make you safe? That belief is exactly what keeps most people financially stuck. Before you go further, subscribe, like, and share this because this one idea alone can change how you see money forever. Here's the uncomfortable truth. Saving money without investing, it is not protection. It's slow motion loss. Every year, prices rise. That quiet force called inflation doesn't announce itself. It just slowly eats what your money can buy. The same cash sitting in your account today will buy less next year, and even less the year after that. Think of someone who saved $10,000 10 years ago and left it untouched. It still looks like $10,000 on paper, but in real life, it behaves like far less. Rent is higher, food is higher, everything costs more. So while the numbers stayed the same, its power shrank in silence. This is where investing changes everything. Investing is not about gambling or chasing fast money. It's about switching from defense to offense. Instead of letting inflation take from you, you start owning assets that grow with or faster than inflation. This idea, the biggest financial mistake, is not losing money in the market, it's never letting your money grow at all. Even small, consistent investments can turn into something powerful over time because of compounding. But nothing compounds if it's sitting idle. That's the hidden trap, safety that slowly becomes loss. If this makes sense, comment, "I understand inflation, so I know you're getting the shift." And stay with this series because what comes next will completely change how you think about wealth building. At the end of all this, remember, saving keeps you still, but investing moves you forward. Most people don't realize they are playing defense their entire financial life. They work, they save, they try to avoid mistakes, but they never actually switch sides of the game. They never move from protecting money to growing it. Before we go deeper, subscribe and stay with this series because this shift alone separates people who struggle from people who build lasting wealth. Imagine two people earning the same salary. The first one saves carefully, keeps money in a bank account, feels responsible. The second does something different. He still saves, but then he puts that money to work in assets that grow over time. At first, the saver looks safer. No risk, no ups and downs. But years pass, and the gap between them quietly becomes massive. This is the hidden transition almost nobody teaches. Defense feels safe, but it doesn't build anything. Offense feels uncomfortable at first, but it creates progress. The wealthy don't just avoid losses. They actively position their money to grow. Staying safe with money is not the same as building wealth. Think of a football team that only defends. They might avoid losing for a while, but they will never win the game. Wealth works the same way. If all you do is protect your money from risk, inflation slowly wins in the background. Moving from defense to offense means accepting that money must be put into motion, into businesses, markets, systems that generate returns. Not recklessly, but intentionally. If this idea is hitting you differently, comment offense mode so I know you're following this shift. And don't miss the next part, because understanding what actually moves wealth forward will change how you see every dollar you earn. Before Warren Buffett became a household name, before billions in headlines, he was just a young reader in Omaha sitting with a book that most people would ignore today. But that one book didn't just teach investing, it rewired how he thought about money for life. Before we continue, subscribe because this is where modern investing thinking truly begins. The book was The Intelligent Investor by Benjamin Graham. At the time, it wasn't written as a motivational guide or a get-rich story. It was written like a manual for thinking clearly in a chaotic market. Dense, serious, almost boring to most readers. But to the right mind, it was revolutionary. Graham didn't promise easy wealth. He didn't sell excitement. Instead, he taught discipline. He taught that investing is not about predicting the future, but about managing your behavior when the future becomes uncertain. That idea alone separates professionals from gamblers. The smartest investor is not the one who knows the future, but the one who stays rational when others lose control. Buffett later called it the greatest investing book ever written, not because it had secrets, but because it removed illusions. It stripped away the fantasy that the market is something you can outsmart emotionally. Think about this. Most people enter investing looking for excitement, but Graham taught boredom as a strategy. Calm thinking, patient action, consistent behavior. While others chase trends, the intelligent investor waits. And here's the deeper truth. Most financial mistakes don't come from lack of knowledge. They come from lack of emotional control when money is at stake. If this is clicking for you, comment "Stay rational" because that's the real skill here. And the next part will show you why the biggest enemy in investing is not the market at all. It's something much closer to home. Before modern investing tools, before financial apps and trading platforms, there was a book that quietly built the foundation of how professionals analyze businesses. It wasn't written for beginners, and it definitely wasn't light reading. But it changed everything about how value is understood in markets. Before we continue, subscribe because this is where investing stops being emotion and starts becoming logic. Benjamin Graham's earlier work, Security Analysis, wasn't about predicting stock prices or chasing trends. It was about breaking companies down like an engineer dissects a machine. What is it worth? What are its real assets? What is the business actually producing underneath all the noise? This shift was massive. Before Graham, most people treated stocks like tickets, something you buy and hope goes up. After Graham, a new idea formed. A stock is not a ticket. It is ownership in a real business with real value. If you don't understand what you own, you're not investing, you're guessing. Think of it like buying a piece of a shop in your city. You wouldn't just ask, "What will someone pay for it next month?" You would ask, "How much profit does this shop actually make?" Graham brought that thinking into markets. And here's the important part. This wasn't about complexity. It was about clarity. Strip away emotion, strip away hype, and focus on what something is truly worth. Most people never do this. They buy based on headlines, excitement, or fear of missing out. Graham taught the opposite: slow thinking, structured analysis, and patience. If this idea is shifting how you think, comment "real value," because that's the foundation of everything that follows. And in the next part, you'll see how Warren Buffett took these ideas and turned them into a lifetime strategy for building wealth. Before Warren Buffett became known as one of the richest people on the planet, he was already doing something most investors never managed to do even once. He was building his entire mindset on a single idea and refusing to abandon it. Before we continue, subscribe because this is where theory becomes lifelong strategy. Buffett didn't just read Benjamin Graham's The Intelligent Investor. He absorbed it like a rule book for life. While most readers finish books and move on, Buffett kept returning to it again and again, even decades later. He didn't treat it as information. He treated it as operating instructions. At the heart of Graham's teaching was a simple but powerful principle. The market is not your master, it is your tool. Most people do the opposite. They let the market dictate their emotions, panic when it falls, excitement when it rises, confusion when it swings wildly. If the market controls your emotions, you're not investing, you are reacting. Buffett understood that success in investing is not about intelligence in the traditional sense. It is about emotional discipline. Two people can read the same news, see the same crash, and respond completely differently. One sells in fear, the other sees opportunity. There's a story Buffett often reflects on, how the lessons from Graham were not about making quick money, but about surviving the emotional storms that destroy most investors before time can even work in their favor. Because here's the truth, markets don't destroy wealth quickly. Human behavior does. If this is starting to make sense, comment "discipline wins" because that's the real edge most people never develop. And in the next part, you'll see the dangerous idea that ruins more investors than any crash ever could. The illusion that you are your own worst financial enemy. You might think your biggest financial threat is a crash, a recession, or some bad investment. But the uncomfortable truth is far simpler and far more personal. Before we continue, subscribe because this is the part where investing stops being about markets and starts being about you. Benjamin Graham said something that sounds almost too honest to be comfortable. The investor's worst enemy is likely to be himself. Not the economy, not Wall Street, not the system, but the person making the decisions. Think about how most people actually behave. They feel confident when prices are rising, so they buy more at higher prices. Then the moment things drop, fear takes over, and they sell at the worst possible time. The same person, the same money, completely different outcomes, because emotions took control. The market doesn't punish you for being wrong. It rewards or destroys you based on how you react. There's a story in everyday life that mirrors this perfectly. Someone invests during a booming period, tells friends they're good with money, feels smart. Then a downturn hits, and suddenly the same person panics, checks their account every hour, and exits at a loss. Nothing changed in the business, only the emotion changed. That is what Graham was pointing at. The real danger isn't lack of knowledge. It's overreaction. It's impatience. It's fear dressed up as urgency. Buffett later built his entire philosophy around this idea. Not finding perfect investments, but avoiding self-destruction. Staying calm when others lose control. Thinking when others react. If this resonates, comment "control myself," because that is the real skill in wealth building. And in the next part, you'll see the most dangerous character in investing psychology. A figure who appears every day and quietly manipulates your decisions without you even realizing it. Every investor thinks they are making independent decisions. But in reality, most people are reacting to something that doesn't even have a physical form. Something imagined, emotional, and constantly changing. Before we continue, subscribe, because once you understand this concept, you will never look at markets the same way again. Benjamin Graham introduced a powerful metaphor called Mr. Market. Imagine you own a small business, and every single day, a partner shows up at your door offering to buy your share or sell you his. Some days he's wildly optimistic, offering absurdly high prices because he believes everything will boom forever. Other days he's terrified, desperate to sell at a fraction of the value because he thinks disaster is coming. The key point is this: his mood has nothing to do with the actual value of the business. Mr. Market is not telling you the truth. He is telling you his emotions. Now here's where most people fail. Instead of ignoring his moods, they start copying them. When prices rise, they feel pressure to buy. When prices fall, they feel panic and sell. They let emotional noise become financial action. In real life, Mr. Market is the stock market itself. It is constantly shifting between optimism and fear, between greed and panic. But it is not a judge of value. It is just a reflection of human emotion at scale. Think of a farmer who checks the weather app every hour and changes planting decisions every time the forecast shifts slightly. That farmer would never harvest anything. Yet that is exactly how most investors behave. Buffett's genius was simple. He stopped treating Mr. Market like a guide and started treating him like a tool. When Mr. Market is overly optimistic, he becomes cautious. When Mr. Market is fearful, he becomes interested. If this idea is clicking, comment, ignore noise, because that's where real discipline begins. And in the next part, you'll see how this emotional cycle creates one of the most consistent patterns in all of investing. Why most people buy high and sell low without even realizing it. Most people believe they are rational when it comes to money. They think they buy when it makes sense and sell when it's necessary. But the truth is far more uncomfortable. Most investing decisions are emotional reactions disguised as logic. Before we continue, subscribe, because once you see this pattern, you'll start recognizing it everywhere. Here's what typically happens. The market starts rising. News becomes positive. Friends start talking about stocks. Social media fills with success stories. Confidence builds slowly, then suddenly feels like certainty. At that point, people rush in, not because of analysis, but because of excitement and fear of missing out. Then the cycle flips. Prices fall. Headlines turn negative. Everyone starts questioning everything. The same people who felt confident at the top now feel panic. And they sell, not because of strategy, but because discomfort becomes unbearable. The market doesn't create your emotions, it reveals them. This is the hidden rhythm of investing behavior. Buy high when confidence is maximum. Sell low when fear is maximum. and repeat it across cycles, often without realizing it. Think of a crowded marketplace. When one stall becomes popular, more people gather, assuming popularity means value. Then when the crowd leaves, others assume something is wrong and avoid it entirely. Very few actually evaluate what's being sold. Markets work the same way, just with higher stakes. The key lesson is simple but difficult. The best opportunities often feel uncomfortable, and the worst decisions often feel safe in the moment. Buffett understood this deeply. He didn't try to avoid market cycles. He tried to avoid emotional participation in them. If this is making sense, comment "break the cycle," because awareness is the first step. And in the next part, you'll see how this emotional behavior isn't just common. It's almost predictable, and why it quietly transfers wealth from one group of people to another. If you step back and really observe how money flows in markets, something uncomfortable becomes clear. It doesn't move randomly between winners and losers. It moves from one type of behavior to another. Before we continue, subscribe, because this idea explains more about wealth transfer than almost anything else in finance. Benjamin Graham and later Warren Buffett both pointed out a simple truth hidden inside decades of market behavior. The stock market is a device for transferring money from the impatient to the patient. That sounds almost too simple, but it's describing a very real pattern. Think about what impatience looks like in investing. It's constantly checking prices. It's reacting to headlines. It's buying when excitement is high and selling when discomfort appears. It's treating every movement like a decision point instead of noise. Now, think about patience. It looks boring. It looks like doing almost nothing. Holding quality assets. Ignoring short-term noise. Letting time do the work while others constantly interrupt the process. This wealth doesn't move to the smartest. It moves to the most consistent. There's a quiet story inside every market cycle. A group of people buys in late during excitement, convinced they are early. Another group sells early during fear, convinced things will get worse. Neither group necessarily lacks intelligence. The difference is emotional timing. Imagine planting a tree and digging it up every week to check if it's growing. That's what impatience does to investing. It destroys the very process that creates results. Buffett's advantage was never speed or prediction. It was endurance, staying invested while others couldn't stay calm. If this is hitting you, comment "stay patient," because patience is the real strategy here. And in the next part, you'll see why doing almost nothing, yes, almost nothing, can actually outperform most professional investors over time. Most people assume that beating the market requires intelligence, constant research, or some secret strategy hidden from everyone else. But the reality is far more surprising and far more uncomfortable. Before we continue, subscribe, because this idea alone can completely change how you approach investing forever. Across decades of data, one pattern keeps repeating itself. Most professional investors, despite access to research teams, tools, and experience, fail to consistently beat simple market averages. Not because they're uninformed, but because their activity becomes their weakness. Every trade, every adjustment, every timing decision introduces friction. Fees, mistakes, emotional reactions, and overconfidence all quietly compound in the wrong direction. Meanwhile, a simple approach, buying broad market exposure and holding it, keeps working in the background without interruption. This, in investing, doing less is often what makes you win more. Think of two people trying to grow a garden. One constantly digs up the soil, replanting seeds, changing locations, adjusting everything daily. The other plants once, waters consistently, and leaves it alone. Months later, the second garden is thriving while the first never had time to grow. Markets work the same way. Growth needs time, not interference. This is why index investing became so powerful. It doesn't rely on prediction. It doesn't rely on timing. It simply captures the average performance of businesses over time and removes human error from the process. If this is changing your perspective, comment, let it grow, because that mindset shift is everything. And in the next part, you'll see how even small fees and hidden costs can silently destroy decades of returns without you noticing. Most people think the market is the real battlefield in investing. But the truth is, the real battle is happening inside your own decisions. And most of the time, it's already lost before you even realize it. Before we continue, subscribe because this is where wealth starts to separate from behavior. Warren Buffett made a simple but powerful observation. Money moves from the impatient to the patient. This isn't philosophy, it's structure. Every market cycle rewards those who can wait and punishes those who cannot sit still. Impatience shows up in subtle ways. Jumping between stocks, reacting to news, selling after short-term drops, buying after short-term rallies. Each action feels justified in the moment, but over time, it creates inconsistency, and inconsistency destroys compounding. The market doesn't reward activity, it rewards endurance. Think of a long-distance race. The fastest runner at the start rarely wins. The winner is the one who understands pacing, who doesn't get distracted by others sprinting ahead, who trusts the process even when it feels slow. Investing works exactly like that. The people who constantly move in and out of positions often end up behind those who simply stayed invested. There's also something psychological happening here. Every time you act, your brain feels like you are doing something smart. But in reality, unnecessary action is often just emotional discomfort disguised as strategy. Buffett's edge was never prediction. It was restraint, the ability to sit through noise without reacting to it. If this is starting to land, comment, "I can wait," because that is the skill most people never develop. And in the next part, you'll see how even professional investors, with all their tools and knowledge, still lose to something incredibly simple, and why that should change how you think about investing forever. Most people assume professional investors have an edge because of intelligence, access, or experience. But when you look at the long-term data, a surprising truth appears: they often don't win. And it's not because they don't know enough, but because their system works against them. Before we continue, subscribe because this is where the illusion of expertise starts to break. Over long periods, simple index funds consistently outperform the majority of actively managed funds. That means thousands of professionals working full-time, researching companies, analyzing markets, still end up behind a basic strategy that does almost nothing, just holds the entire market. At first, this feels impossible. How can doing less beat doing more? But the answer isn't about knowledge. It's about cost, behavior, and timing mistakes that accumulate quietly over time. This complexity doesn't create advantage. Discipline does. Every active decision introduces friction. Buying and selling creates fees. Frequent changes create tax inefficiencies. Constant adjustments increase the chance of emotional mistakes. And all of this compounds in the background, slowly pulling returns down. Think of it like running a marathon while carrying extra weight. Each step still moves you forward, but you're spending more energy just to keep up. That's what active investing often becomes: effort that quietly works against itself. Meanwhile, index investing removes all of that friction. No guessing, no switching, no emotional interference. Just consistent exposure to the market's long-term growth. If this is shifting your perspective, comment "less is more," because this is one of the most important truths in investing. And in the next part, you'll see how fees, small, almost invisible percentages, can quietly erase decades of progress without most people ever noticing. Most people ignore small numbers. A 1% fee doesn't feel like anything worth worrying about. It looks harmless, almost irrelevant. But in investing, the smallest percentages often create the biggest long-term damage. Before we continue, subscribe because this is where wealth quietly disappears without any dramatic warning. Imagine two investors. Both start with the same amount. Both earn the same returns before fees. The only difference is that one pays 1.5% annually in fees, and the other pays almost nothing. In the first year, the gap feels tiny. In 5 years, still not shocking. But give it 2 or 3 decades, and the difference becomes massive. The reason is simple. Fees don't just take money once. They take it every single year, and they take it before compounding has a chance to grow your returns. This The most dangerous costs are the ones you don't feel immediately. Think of it like a small leak in a water tank. At first, it looks harmless. A few drops lost each day don't seem important. But over time, the tank that should have been full is only half full, then a quarter full, while the other tank stays intact. That's exactly how expense ratios and management fees work in investing. They quietly reduce the base that everything else compounds on. And here's the deeper problem. Most people don't even notice it happening. It's hidden inside statements, percentages, and financial language that feels too technical to question. Buffett himself has often pointed out that cost matters more than most people realize. Not because returns don't matter, but because costs are guaranteed while returns are not. If this is opening your eyes, comment, watch the fees, because awareness is the first offense. And in the next part, you'll see how even a small percentage difference can destroy more than 30% of your total lifetime wealth without you ever making a single bad investment. Most people think wealth is built only by picking the right investments or earning higher returns. But there's a hidden force working in the background that quietly decides how much of that wealth you actually keep. Before we continue, subscribe, because this is where the math of investing becomes uncomfortable but essential. Compounding is often described as the most powerful force in finance. It's the idea that your money earns returns, and then those returns earn returns too. Over time, this creates exponential growth. But what most people forget is that compounding doesn't just work on gains, it also works on losses like fees. A small annual fee doesn't stay small. It compounds against you year after year, reducing not just your money, but every future return that money could have generated. This compounding doesn't care whether it's helping you or hurting you. It just multiplies whatever is there. Imagine two identical snowballs rolling down a hill. One is clean snow, gaining size with every turn. The other has a thin layer shaved off each time it rolls. At first, the difference is invisible, but halfway down the hill, one is massive while the other is noticeably smaller. By the end, the gap is not slight, it is enormous. That is what fees do over time. They don't at once. They reduce the base every single year before growth even begins. This is why a difference like 1% or 2% in fees can result in losing over 30% of your total lifetime wealth. Not because the returns were bad, but because a portion of every future return never had a chance to exist. If this is sinking in, comment compounding matters, because this is the engine behind everything in wealth building. And in the next part, you'll see how one simple decision, choosing the wrong type of fund, can quietly shift you from winning the market to permanently trailing it. Most investors think the real decision is what to invest in: stocks, real estate, or crypto. But in reality, one of the most important decisions happens before any of that. It's not about picking winners. It's about choosing the system you use to invest in the first place. Before we continue, subscribe, because this is where most people unknowingly lock in underperformance for decades. In the 1970s, John Bogle introduced something that Wall Street didn't take seriously at first: the index fund. Instead of trying to beat the market, it simply aimed to become the market. It held everything in proportion, quietly tracking the entire economy instead of betting on individual outcomes. At the time, this sounded almost lazy. Why settle for average when you could try to outperform? That was the mindset. But what most people missed is that average before costs often becomes above average after them. Sometimes the smartest strategy isn't beating the market, it's refusing to fight it. Think of two travelers trying to reach the same destination. One constantly changes routes, looking for shortcuts, stopping to ask for advice, switching direction whenever something looks faster. The other follows a single direct road without deviation. Over time, the second traveler arrives first, not because they were faster, but because they never got lost. That's the index fund philosophy. No prediction, no switching, no emotional interference. Just consistent participation in the growth of businesses over time. And here's what made Bogle's idea powerful. It didn't require genius. It required patience and discipline. It removed the need for constant decisions, which is exactly where most mistakes happen. If this is making sense, comment "Stay simple," because simplicity is the real advantage here. And in the next part, you'll see why even the smartest professionals in finance still struggle to beat this approach, and what that reveals about the real nature of investing. Most people assume that if someone is trained in finance, works full-time in markets, and has access to elite research, they should naturally outperform everyone else. But when you look at long-term results, a strange pattern appears. They often don't. Before we continue, subscribe, because this is where the illusion of professional advantage starts to break apart. The uncomfortable reality is that professional investors don't compete against uninformed individuals. They compete against each other. And in doing so, they collectively become the market itself. Every trade, every analysis, every strategy is already reflected in prices almost instantly, because thousands of other professionals are doing the exact same thing. So even if someone finds an advantage, it gets competed away quickly. By the time it's widely known, it's no longer an advantage at all. In investing, the moment an edge becomes obvious, it usually stops being an edge. Think of a crowded marketplace where every seller is highly skilled, experienced, and constantly adjusting prices based on what others are doing. In that environment, it becomes very difficult for any single seller to consistently undercut or outperform the rest. The competition itself keeps everyone locked in the same range. That's what happens in active fund management. High skill, high competition, high costs, and in the end, average results after fees. This is why so many professionals struggle to consistently beat simple index investing. It's not a lack of intelligence. It's a structural problem. Costs, competition, and timing errors stack up against them over time. If this is changing how you think, comment "System wins," because structure matters more than skill here. And in the next part, you'll see how even when markets go up long-term, most investors still lose. Not because of what they buy, but because of when they decide to buy and sell. Most people think investing success is about finding the right stock, the right fund, or the right timing. But the deeper truth is far less glamorous and far more important. Before we continue, subscribe, because this is where we uncover why even good decisions often lead to bad outcomes. Markets over long periods tend to rise. Businesses grow, economies expand, and value is created over time. But despite this upward trend, many investors still underperform the very market they are trying to beat. The reason isn't what they choose, it's how they behave around those choices. Every investor faces the same sequence: excitement, doubt, fear, regret. They buy when confidence is high and sell when fear becomes overwhelming. This cycle repeats across decades, silently eroding returns. It's not the market that hurts most investors, it's their timing inside it. Think of a river that flows steadily in one direction. On paper, it looks predictable. But if you keep jumping in and out of the water, trying to optimize your experience, you end up missing the flow entirely. You get exhausted while the river keeps moving forward without you. That's what happens with frequent trading, panic selling, and emotional reentry. The market's long-term growth continues, but the investor's participation becomes fragmented. Even a small number of bad timing decisions can undo years of steady gains. Selling during downturns, sitting out recoveries, or chasing late-stage rallies creates gaps that are extremely hard to recover from. If this is clicking, comment "Stay invested," because consistency is the real edge. And in the next part, you'll see how investor behavior, not market performance, is actually the biggest reason most people fall behind over time. Most people assume that if they just pick better investments, they'll do better than average. But over time, a more uncomfortable truth shows up again and again. It's not the investments that usually fail, it's the behavior around them. Before we continue, subscribe, because this is where investing stops being about markets and becomes about human nature. On paper, markets deliver solid long-term returns. Over decades, they reward ownership in businesses and patient capital. But individual investors rarely experience those paper returns in real life. Why? Because they're constantly moving in and out of positions. They buy after hearing good news. They sell after seeing bad news. They shift strategies when things feel uncertain. Each move feels logical in isolation, but together they create a pattern of disruption that breaks compounding. The average investor doesn't lose to the market. They lose to their own behavior inside the market. Think of a person trying to read a book, but flipping pages every few seconds to check if another book is better. They never actually finish the story they started. Not because the book was bad, but because they never stayed with it long enough to understand it. That's exactly what happens in investing when people constantly switch strategies or react emotionally to short-term noise. The market doesn't require perfection. It requires participation over time. But behavior interrupts that participation again and again. Even small mistakes like selling during a dip or buying late into a rally don't just reduce returns once. They remove entire periods of growth that would have happened if the investor had simply stayed still. If this is resonating, comment "Stop switching," because consistency is the real edge here. And in the next part, you'll see why volatility feels dangerous, but often isn't what actually destroys wealth. Most people look at investing and think the hardest part is picking what to buy. But in reality, the real difficulty is not selection. It's staying consistent after you've already chosen. Before we continue, subscribe, because this is where behavior quietly becomes the difference between wealth and regret. There's a powerful pattern hidden in decades of investor data. People don't underperform because they pick terrible investments. They underperform because they move their money too often. Every time money is shifted, a decision is made under emotion, fear, excitement, uncertainty, or impatience. And those emotions don't just affect one trade. They affect the entire timeline of compounding. Investing isn't destroyed by bad choices. It's destroyed by repeated interruptions to good ones. Think of a farmer who plants seeds but keeps digging them up every few weeks to check progress or try a better spot. The soil never gets a chance to do its job. Growth is constantly reset before it can begin. That's what frequent portfolio changes do. They interrupt the natural cycle where time does most of the work. Markets naturally move through cycles: growth, correction, recovery. But investors often exit during the worst part of the cycle and re-enter after the recovery has already begun. That means they miss the very phases that create most of the long-term return. Even if the market itself performs well, the investor's personal experience of it becomes fragmented and incomplete. If this is clicking, comment, let it run, because that mindset shift is crucial. And in the next part, you'll see why volatility feels so dangerous to the human brain, but is often completely misunderstood when it comes to real financial risk. Most people look at a falling portfolio and immediately think one thing: risk. But what feels like risk in the moment is often something very different in reality. Before we continue, subscribe, because this is where understanding risk changes how you behave with money forever. When markets drop, the emotional reaction is immediate. Fear rises. The urge to act becomes strong. People feel like something is being lost in real time. But in most cases, nothing is actually lost unless you make a decision in that moment. A temporary decline in value is not the same as a permanent loss. Yet emotionally, the brain treats both as identical threats. That's where most investing mistakes begin. This volatility feels like danger, but it is not the same as risk. Think of a person watching waves crash against the shoreline. The water level rises and falls constantly. To someone standing there, it might feel unstable, even dangerous. But the shoreline itself isn't being destroyed, it's just experiencing movement. Markets behave in a similar way. Prices move up and down constantly, but that movement alone does not determine long-term outcome. Real risk appears only when a loss becomes permanent, when something is sold at the wrong time, or when capital is allocated in a way that cannot recover. That's very different from seeing temporary declines on paper. The problem is, most people don't wait long enough to understand that difference. They react to movement instead of outcome. If this is shifting your perspective, comment "Don't panic," because emotional control is the real skill here. And in the next part, You'll see why what feels safe in the short term is often what destroys long-term financial success. Most people assume investing and gambling are opposites. One feels responsible, the other feels reckless. But if you look closely at behavior, not labels, the line between them is often much thinner than people want to admit. Before we continue, subscribe because this is where perception meets reality. Gambling is defined by risking money on uncertain short-term outcomes where the odds are usually against you. Investing, in its true form, is about owning productive assets that grow value over long periods of time. On paper, they are completely different systems. But here's where things get uncomfortable. Many investors unknowingly behave like gamblers. They chase short-term moves. They react to news like it's a signal to act immediately. They buy high during excitement and sell low during fear. They focus on quick outcomes instead of long-term ownership. The behavior starts to mirror gambling, even if the label is investing. The difference isn't what you call it, it's how long you stay in it. Think of someone entering a casino, but convincing themselves they are investing in luck. They watch patterns, believe they see signals, and make repeated bets based on emotion. Over time, the structure of their behavior, not their intention, determines the outcome. Markets can create the same illusion. Rapid price changes, constant news updates, and social pressure make short-term movement feel important. But importance is not the same as relevance. True investing removes the need for constant decisions. It shifts focus from prediction to ownership, from reaction to patience. If this is landing for you, comment long game, because that mindset is the real separator. In the next part, you'll see how diversification quietly protects investors from catastrophic mistakes while still allowing long-term growth to compound. Most people think investing is about finding one perfect opportunity that will change everything. But the reality is far less dramatic and far more powerful. Before we continue, subscribe because this is where risk stops being scary and starts becoming manageable. There's a simple idea in finance that sounds almost too basic to matter: diversification. It means not putting all your money into one stock, one sector, or one outcome. Instead, spreading your investments across many different assets so that no single failure can destroy you. At first, this feels like it should reduce returns. After all, if one investment does extremely well, wouldn't owning many just dilute that success? That's the common intuition. But over time, diversification does something more important than maximizing upside. It protects you from permanent damage. In investing, survival matters more than perfection. Think of a sailor crossing the ocean. He doesn't rely on one single rope, one sail, or one system working perfectly. He builds redundancy. Because in a storm, it's not about achieving the best possible speed, it's about not sinking. Diversification works the same way. Some investments will perform poorly. Some will underperform. A few will do exceptionally well. But you don't need to predict which is which in advance. You just need to ensure no single failure wipes you out. This is what Graham meant when he called diversification the closest thing to a free lunch in investing. You reduce risk without necessarily reducing long-term returns, because you're smoothing out the impact of uncertainty rather than trying to eliminate it. If this is clicking, comment, stay protected, because protecting downside is what keeps you in the game long enough to win. And in the next part, you'll see how time, not skill, not timing, not predictions, is what ultimately turns small investments into extraordinary outcomes. Most people underestimate time in investing because it doesn't feel like a strategy. It feels like waiting. But in reality, time is not passive. It is the engine that turns small, ordinary decisions into extraordinary outcomes. Before we continue, subscribe because this is where wealth stops being about effort and starts being about duration. Compounding is often explained as earning returns on your returns. But what people miss is that it starts extremely slowly. In the early years, progress feels almost invisible. The numbers barely move. That's why most people give up or assume it's not working. But compounding doesn't announce itself in the beginning. It builds quietly in the background until it reaches a point where growth accelerates dramatically. This Compounding is boring for years. Then it becomes unstoppable. Think of a snowball rolling down a long hill. At first, it picks up only a little snow. It seems insignificant, but as it continues, it grows larger, gathers more surface area, and starts accelerating. By the time it reaches the bottom, it is completely unrecognizable compared to where it started. Investing works exactly the same way. The early phase tests your patience. The middle phase tests your discipline. The late phase looks like magic, but it's just time doing its job. This is why starting early matters more than trying to be perfect. Even small amounts invested consistently can outperform large amounts invested late, simply because time multiplies everything. If this is landing for you, comment "Trust Time," because this is the real foundation of long-term wealth. And in the next part, you'll see the story of Warren Buffett's wealth curve and why almost all of his fortune came much later than most people expect. Most people imagine Warren Buffett's wealth as a straight climb, slowly building, year by year, decade by decade. But the reality is far more surprising and far more important for anyone trying to understand how wealth actually works. Before we continue, subscribe, because this is where time reveals its true power. Buffett didn't become extremely wealthy in his 20s or 30s. In fact, for much of his early career, his progress looked steady but not extraordinary. He was already successful, already skilled, already disciplined, but not yet in the realm most people associate with billionaire status. The real transformation came much later. The majority of Buffett's net worth wasn't built early. It was built after he turned 50. And even more dramatically, a huge portion of it came after 60. That surprises most people because it goes against the instinct that wealth is something you achieve quickly if you are good enough. The biggest misunderstanding in wealth is thinking it grows linearly when it actually explodes later in life. Think of a tree that spends decades growing roots underground before anything impressive appears above the surface. For a long time, nothing looks significant. But once it matures, growth becomes exponential, not incremental. Buffett's investing didn't suddenly change later in life. The principles stayed the same: patience, discipline, long-term thinking, and staying invested in quality businesses. What changed was the scale of compounding. The base had become so large that growth itself became powerful. This is the hidden truth most people miss. Early years are about building the base, not seeing the results. If this is shifting your perspective, comment "long horizon," because understanding this removes the pressure to get rich quickly. And in the next part, you'll see why time, not intelligence or effort, is the most unfair advantage in all of investing. Most people think wealth is built through intelligence, effort, or finding the right opportunity at the right time. But the most powerful factor in investing is something far simpler and far less glamorous. Before we continue, subscribe, because this is where everything you think about success and money starts to shift. Time is the one ingredient that cannot be replaced. You can recover from mistakes. You can increase income. You can even rebuild after setbacks. But you cannot replace lost time. And in investing, time is what allows compounding to do its work. Compounding doesn't reward speed, it rewards duration. The longer you stay invested, the more powerful the effect becomes. Not because the returns change dramatically, but because the base keeps growing on itself. In wealth building, time is not just a factor, it is the multiplier of everything else. Think of two people planting trees. One plants early and tends it patiently for decades. The other plants later, but tries to force growth with constant intervention. Even if the second person works harder, the first tree ends up larger simply because it had more time to grow. That's why Buffett's results look extraordinary. Not because he started differently, but because he stayed in the game long enough for compounding to fully express itself. Most people underestimate how long-term actually is. They think in months or a few years. But real compounding stories unfold over decades. And that's exactly why patience is so rare and so valuable. If this is landing for you, comment, "Give it time," because this mindset is what separates short-term thinking from real wealth building. And in the next part, you'll see how Wall Street's complexity is often designed to make simple strategies feel wrong, even when they're working perfectly. Most people believe investing is complicated by nature. Charts, indicators, experts, predictions, it all feels like something only professionals can truly understand. But in reality, much of this complexity is not necessary for success. Before we continue, subscribe because this is where clarity begins to cut through confusion. The financial industry has a natural incentive to make investing feel complicated. Complexity creates dependence. If something feels too difficult to do alone, people are more likely to pay for help, tools, or advice. And that system quietly rewards activity, not simplicity. But here's the paradox. The more complicated investing becomes, the more opportunities there are to make mistakes. This complexity in investing doesn't increase returns. It usually increases interference. Think of a simple machine that works perfectly when left alone. Now imagine adding switches, buttons, and adjustments that don't improve its function, but tempt the operator to constantly change settings. Over time, the machine performs worse, not because it's flawed, but because it is constantly being disturbed. That's what happens when investors overcomplicate their process. Constant analysis, constant switching, constant reacting, all of it introduces noise into something that already works over long periods. The simplest strategies often outperform because they reduce human interference. They don't rely on perfect timing or perfect decisions. They rely on consistency and time. If this is clicking, comment, keep it simple, because simplicity is a form of discipline. In the next part, you'll see how financial theory from decades ago already proved why most people cannot consistently predict markets, no matter how smart they are. Most people assume that if they just study harder, follow more experts, or analyze more data, they can eventually predict where the market is going. But decades of research quietly show something very different. Before we continue, subscribe, because this is where the idea of beating the market starts to fall apart. In the early 1970s, economist Burton Malkiel introduced a powerful concept in a random walk down Wall Street. His argument was simple but disruptive. Stock prices in the short-term move in ways that are essentially unpredictable because they already reflect all known information. This means that by the time you hear news, read analysis, or see a prediction, the market has already processed it. If information is public, it's already priced in. Think about a crowd reacting to a sudden announcement. The moment the news appears, people react instantly. Prices adjust immediately. By the time an article explains why it happened, the opportunity is already gone. The explanation comes after the movement, not before it. This is why even very intelligent professionals struggle to consistently predict short-term market direction. It's not a lack of effort. It's a structural reality. Millions of participants are constantly reacting at the same time, making prediction extremely difficult. Malkiel's core point wasn't that analysis is useless. It's that short-term prediction is unreliable as a strategy for consistent success. If this is making sense, comment unpredictable, because accepting this removes a lot of unnecessary pressure. And in the next part, you'll see how financial news often creates convincing stories about markets that feel true, but are usually built after the fact. Most people watch financial news and assume they're getting insight into what is happening in the market. It feels structured, analytical, even authoritative. But what you're often seeing is something very different. Before we continue, subscribe, because this is where perception and reality start to separate. Every day, markets move up or down, and immediately after, explanations appear. Markets fell due to inflation concerns. Stocks rose on investor optimism. These statements sound precise, but they are often reconstructed narratives, not real causes. The truth is, millions of decisions happen simultaneously in the market for millions of different reasons. Reducing that complexity into a single headline is not analysis. It's simplification after the fact. Most market explanations are stories built after the outcome, not reasons that caused it. Think of someone watching a crowd from a distance. If the crowd moves left, they might assume everyone moved because of one signal. But in reality, each person had different reasons. Some saw something, some followed others, some were just adjusting their position. The observer creates a single explanation because it feels easier to understand. Financial news works the same way. It turns complex, chaotic systems into clean stories that feel satisfying but are rarely complete. The danger is subtle. When people hear these narratives repeatedly, they start believing they can predict future movements based on similar reasoning. But since the explanations are often built after the fact, they don't actually provide predictive value. If this is opening your eyes, comment "see through it," because awareness of narrative bias is powerful. And in the next part, you'll see the real difference between temporary volatility and permanent financial risk, and why confusing the two leads to costly mistakes. Most people think risk in investing is about prices going up and down every day. They see volatility on a chart and immediately assume danger. But that assumption is one of the most expensive misunderstandings in finance. Before we continue, subscribe because this is where real investing risk finally gets clarified. Volatility is just movement. Prices fluctuating in the short term say very little about whether an investment is good or bad. A strong business can drop in value temporarily. A weak business can rise temporarily. The movement itself doesn't tell the full story. The real danger is not fluctuation, it's permanent loss of capital. This volatility is noise, but permanent loss is damage. Think of waves in the ocean. From the shore, they rise and fall constantly, sometimes calm, sometimes violent. But the ocean itself isn't disappearing or breaking because of those waves. The structure remains intact. Now imagine a different scenario where something actually gets removed from the system permanently. That is when true loss occurs. In investing, permanent loss happens when decisions are made at the wrong time. Selling during panic, investing in something fundamentally broken, or locking money in situations where recovery is not possible. This is why experienced investors focus less on daily price movement and more on whether the underlying asset is still strong and whether they can afford to wait. If this is making sense, comment "real risk" because understanding this changes how you react to every market drop. And in the next part, you'll see how one of the most respected investors in the world explains risk as something you cannot even see in hindsight, and why that changes everything about how success and failure are judged. Most people look at investing results and assume they can clearly tell what was smart and what was risky. If something went up, it must have been a good, safe decision. If it went down, it must have been bad or dangerous. But this is one of the biggest illusions in finance. Before we continue, subscribe because this is where hindsight starts to mislead judgment. Howard Marks, one of the most respected investors in the world, explains something that changes how you evaluate every outcome. Risk is invisible in hindsight. You cannot look at a past result and accurately measure how risky it actually was. A decision that made money might have been extremely risky, but simply got lucky. A decision that lost money might have been very safe in structure, but suffered bad timing. The outcome alone doesn't reveal the level of risk taken. Results tell you what happened, not how dangerous the path really was. Think of two people crossing a road. One crosses carefully but gets unlucky with timing and faces a near miss. The other crosses recklessly, but nothing happens. If you only judge by outcome, you would think the reckless person was safe and the careful one was risky. But reality is the opposite. This is what makes investing evaluation so misleading. We naturally judge decisions based on results because that's what we can see. But real risk lives in the process, not the outcome. Mark's insight forces a shift in thinking. Good investing is not about always winning. It's about managing exposure so that even when things go wrong, you are not destroyed. If this is resonating, comment "look deeper" because surface-level results are often misleading. And in the next part, you'll see why getting rich and staying rich require completely different skills, and why most people only understand one of them. Most people think becoming wealthy and staying wealthy are the same skill. Earn money, invest it well, and you're done. But in reality, These are two completely different phases that require completely different mindsets. Before we continue, subscribe because this is where wealth stops being about making money and starts being about protecting it. Getting rich usually requires risk. Starting a business, investing early, making bold decisions, taking uncertainty head-on. These actions often involve discomfort and volatility. Without risk, most people never reach significant wealth in the first place. But staying rich is different. It's not about taking more risk. It's about avoiding unnecessary risk. It's about preserving what has already been built, resisting emotional decisions, and protecting capital from permanent damage. Getting rich is about courage, but staying rich is about control. Think of climbing a mountain. The ascent requires energy, effort, and bold movement upward. But once you reach the top, the challenge changes completely. Now it's about balance, awareness, and not slipping. One wrong step can undo years of progress. Investing works the same way. Early on, risk helps you grow. Later, uncontrolled risk destroys what you built. This is why many people who make money quickly often lose it just as fast. They never transition from growth mindset to preservation mindset. If this is landing for you, comment protect it because preserving wealth is a skill most people never learn. And in the next part, you'll see how behavioral finance explains why humans are naturally wired to make the exact wrong financial decisions at the exact wrong times. Most people assume financial mistakes come from lack of knowledge. If they just learned more, studied harder, or followed better advice, they would make better decisions. But the truth is more uncomfortable. Most mistakes come from how the human brain is wired, not what it knows. Before we continue, subscribe, because this is where investing turns into psychology. Behavioral finance emerged when economists realized something important. Humans don't act like perfectly rational calculators. We act emotionally, inconsistently, and often predictably irrational. Daniel Kahneman and Amos Tversky showed this clearly through decades of research that later reshaped modern economics. They discovered that the brain doesn't use just one system for thinking. One part is fast, automatic, and emotional. The other is slow, deliberate, and logical. Most of the time, especially under stress, the fast system takes control. Your brain is not designed to maximize money. It's designed to avoid pain. Think about what happens during a market crash. Prices fall, headlines turn negative, uncertainty rises. Logically, this might be a time to stay calm or even look for opportunity. But emotionally, the brain interprets it as danger. The instinct is to escape, not analyze. Now, think about a booming market. Everything feels safe, exciting, rewarding. The emotional brain encourages action. Buy more, don't miss out, keep going. Logic often gets overridden by excitement. This is why investors repeatedly buy high and sell low, even when they understand the opposite is better. If this is resonating, comment train the mind because awareness is the first step to control. And in the next part, you'll see how fear and greed aren't just emotions. They are biological systems that silently influence every financial decision you make. Most people think investing success is about finding better information or smarter strategies. But even with perfect information, many still fail. Why? Because the real obstacle isn't the market. It's emotional behavior under pressure. Before we continue, subscribe, because this is where investing becomes a test of human control. Fear and greed are not just feelings. They are biological responses built into the human brain over thousands of years. Fear activates when we sense loss or danger. Greed activates when we sense opportunity or reward. Both are designed for survival, not for financial decision-making. In ancient environments, fear helped you avoid predators. Greed helped you gather resources when conditions were good. But in modern markets, these same systems misfire. A temporary price drop triggers fear as if something is physically threatening you. A rising market triggers greed as if opportunity must be seized immediately. Your biology reacts to markets as if they are survival situations, but they are not. Think of someone standing in front of a screen watching numbers move. There is no physical danger, Yet their heart rate increases, their decisions speed up, and their judgment becomes reactive. The body doesn't distinguish between real threat and financial fluctuation. This is why investors often do the opposite of what logic suggests. Fear pushes them to sell during downturns. Greed pushes them to buy during peaks. The emotional system reacts first, and rational thinking comes too late. If this is clicking, comment, control emotions, because this is the real battlefield in investing. And in the next part, you'll see how successful investors build systems, not willpower, to protect themselves from these instincts. Most people think the key to better investing is stronger willpower. They believe if they try harder, stay more disciplined, and think more carefully in the moment, they'll make better decisions. But in reality, willpower is one of the weakest tools you can rely on when money and emotions collide. Before we continue, subscribe, because this is where investing becomes system-based, not emotion-based. The problem with willpower is that it disappears exactly when you need it most. During market crashes, fear is high. During market booms, excitement is high. These are the exact moments when decisions matter, and also the moments when emotional pressure is strongest. That's why relying on just staying calm or just thinking clearly fails so often. The environment is too powerful for the mind alone to consistently resist. You don't rise to your financial decisions. You fall to your systems. Think of someone trying to eat healthy using only willpower. For a few days, they succeed. But when stress hits or temptation appears, discipline breaks. Now compare that to someone who simply removes junk food from their environment. No constant struggle, no daily battle. Just a system that makes the right choice automatic. Investing works the same way. The goal is not to fight emotional reactions every time they appear. The goal is to design a structure where emotional reactions don't control outcomes. That might mean automatic investing, long-term portfolios, limited portfolio checking, or rules that prevent impulsive decisions. The less you rely on in-the-moment discipline, the more consistent your results become. If this is resonating, comment, build systems, because systems outperform motivation every time. And in the next part, you'll see why most investment mistakes happen not during normal times, but during emotional life events when clarity disappears completely. Most people believe they make financial decisions based on logic. But in reality, the timing of those decisions is often controlled by something far more powerful than logic: stress, pressure, and emotional overload. Before we continue, subscribe, because this is where money decisions become deeply human. Daniel Kahneman's research showed that under emotional stress, the brain shifts into fast, reactive thinking. This is useful in emergencies, but dangerous in investing, because financial crises feel like emergencies even when they are not. Now think about when people make the biggest financial changes in their lives. It's not during calm, stable periods. It's during major life events: divorce, job loss, inheritance, illness, relocation, or sudden financial windfalls. These moments feel urgent. They feel like something must be done immediately. And that urgency leads to decisions that are rarely fully rational. The worst financial decisions are often made when life feels most uncertain. Think of someone who just experienced a major life shift. Their emotional world is unstable. Their identity may feel shaken. In that state, they open investment accounts, restructure portfolios, move money around, or chase safe options, not because of strategy, but because they're trying to regain control. But markets don't reward emotional clarity. They reward patience over time. Decisions made in emotional states often reflect temporary feelings, not long-term goals. That's why experienced investors often delay major financial actions during high-stress periods. They understand that clarity returns with time, but damage from rushed decisions can last for years. If this is landing for you, comment "pause" first, because timing matters as much as the decision itself. And in the next part, you'll see how one famous book revealed that most wealthy people don't look rich at all, and why that completely changes how we define success. Most people assume wealthy individuals look a certain way: luxury cars, expensive clothes, big houses, and constant spending. But when researchers actually studied real millionaires over long periods, they found something very different. Before we continue, subscribe because this is where perception of wealth gets completely rewritten. The book The Millionaire Next Door revealed a surprising pattern. Most wealthy people don't look wealthy at all. Instead of flashy lifestyles, they often live modestly, spend carefully, and prioritize financial independence over visible status. Many drive older cars, live in the same house for decades, and avoid unnecessary luxury spending. Not because they cannot afford more, but because they understand what wealth actually is. Rehook this. Real wealth is not what you show, it's what you don't spend. Think about two neighbors. One earns a high income and immediately upgrades everything. House, car, lifestyle. The other earns well, but quietly saves and invests the difference. From the outside, the first looks richer, but over time, their financial reality diverges completely. One builds assets, the other builds expenses. This is the hidden difference. Income creates the illusion of wealth, but savings and investing create actual wealth. And most people confuse the two for years. The researchers called disciplined accumulators prodigious accumulators of wealth. People whose net worth is far higher than expected for their income level. Their advantage wasn't high income alone, but behavior, spending less than they earn consistently over time. If this is clicking, comment hidden wealth, because what you don't see often matters more than what you do. And in the next part, you'll see why your home, often considered your biggest investment, may not actually function as an investment at all. Most people believe owning a home is automatically a great investment. It feels like progress, stability, and financial success all at once. But when you separate emotion from numbers, the picture becomes more complicated than most people realize. Before we continue, subscribe because this is where a deeply held financial belief gets challenged. A home provides value, no doubt about that. It gives shelter, stability, and a sense of belonging. But calling it an investment in the same way as income-generating assets is where confusion begins. An investment typically generates cash flow or returns. A house you live in, however, doesn't produce income, it consumes it. Maintenance, repairs, taxes, insurance, and interest payments all flow outward continuously. Rehook this. Not everything that grows in value is an investment. Some things are just expensive comfort. Think of two people. One buys a home that stretches their finances but feels like success. The other rents a modest place and invests the difference consistently over time. On the surface, the homeowner feels more secure. But financially, the renter may be quietly building more long-term wealth. This doesn't mean homeownership is bad. It means misunderstanding its role is dangerous. A home is primarily a consumption decision with potential appreciation, not a guaranteed wealth-building engine. The key mistake happens when people tie too much of their net worth into a single, illiquid asset and assume it will solve all financial concerns. That creates concentration risk that is often ignored because it feels normal. If this is making sense, comment real asset thinking, because clarity here changes long-term decisions. And in the next part, you'll see a powerful idea that true wealth is not money in your account, but the amount of time your money allows you to control. Most people measure wealth by numbers in a bank account, income statements, or the value of assets they own. But those numbers don't fully explain what wealth actually feels like in real life. Before we continue, subscribe because this is where money stops being just math and starts becoming freedom. True wealth is not just about how much money you have. It's about how much time you control. Time to choose your work. Time to step away when you want. Time to be present in your own life instead of constantly trading hours for income. Two people can have the same net worth on paper, but very different levels of freedom. One might need to work every day just to maintain their lifestyle. The other might have enough invested to live without needing active income. The difference isn't the number, it's the flexibility behind it. Rehook this. Wealth is not what you own. It's how long you can live without needing more money. Think of someone stuck in a job they dislike, but cannot leave because their expenses depend entirely on their salary. Now imagine someone else who can take months off without financial pressure. The second person may not appear dramatically richer, but their relationship with time is completely different. That difference is what financial independence is really about. Not luxury, not excess, but options, the ability to say yes or no without financial fear shaping the decision. And once you understand this, spending decisions also change. Every purchase becomes a trade between current comfort and future time freedom. If this is resonating, comment "Time is wealth," because this shift changes how you evaluate every financial decision. And in the next part, you'll see how one author broke down spending habits in a way that makes every purchase feel like a life trade rather than just a transaction. Most people think wealth building is about earning more, investing better, or finding smarter financial strategies. But one of the most powerful shifts in personal finance has nothing to do with making money. It has to do with how you think about spending it. Before we continue, subscribe because this is where money becomes connected to your life in a very real way. Every purchase you make is not just a transaction, it is a trade. You are trading a portion of your life energy, your working hours, your effort for something in return. When you frame it this way, money stops being abstract and becomes deeply personal. That coffee, that gadget, that upgrade, it's not just a price tag. It's time, hours of work, days of effort, pieces of your limited life converted into something temporary or permanent. Every dollar you spend is a piece of your life you can never get back. Think about someone who works long hours for years, constantly earning and spending without thinking in this way. Now, imagine they suddenly calculate each purchase in terms of work hours instead of money. A small daily habit like ordering food becomes a chunk of their working life. A major purchase becomes months or even years of labor. This perspective doesn't exist to create guilt. It exists to create clarity. Because once you see money as time, you naturally begin to question what is truly worth it. That's the foundation behind financial independence philosophies like your money or your life, where spending is evaluated not just on price, but on life impact. If this is clicking, comment "Value my time," because this is where financial awareness becomes real. And in the next part, you'll see how some people optimize spending not by cutting everything, but by intentionally spending more on what actually matters to them while ignoring everything else. Most people think building wealth means constantly cutting costs, avoiding everything enjoyable, and living a restricted life. But that approach misses the real goal of money entirely. Before we continue, subscribe because this is where financial discipline becomes personal freedom instead of deprivation. A smarter approach is not about spending less on everything. It's about spending intentionally. Some people cut small pleasures like coffee or meals out, while still overspending on things they don't truly value. Others do the opposite. They eliminate wasteful spending completely and freely invest in what actually improves their life. This idea changes everything. Money is not meant to be hoarded. It's meant to be directed. When aligned properly, it supports your priorities instead of competing with them. Wealth is not about restriction. It's about alignment. Think of someone who constantly denies themselves small joys, saving every penny, but feels unhappy and deprived. Now compare that to someone who cuts unnecessary expenses without hesitation, but spends generously on experiences, learning, or things that genuinely matter to them. The second person doesn't feel restricted. They feel in control. That control is the real goal. Not obsession with saving, not reckless spending, but clarity about what deserves your money and what doesn't. Ramit Sethi often emphasizes this approach. Automate savings, eliminate waste, and spend boldly on your priorities. Because the problem is not spending itself, it's unconscious spending. If this is resonating, comment "Intentional money," because clarity is what turns money into a tool instead of a stress source. And this brings us to the final truth. When you strip everything away, every strategy, every book, every theory, wealth building always comes back to a few simple rules that never change.